Hi folks, welcome to this video on adjusting entries. We have a company here, ABC Company. They're trying to complete their accounting process for the first year ended December 31st, 2017. So they must have started business at some point in time during that year because it says their first year ended. We've got some transactions below that are or some information below which is going to help us to prepare any adjusting entries at the end of the period. Now you remember the reason we do adjusting entries is to make sure we've got revenues and expenses recorded in the proper period. So we want to make sure that any revenues we've earned and any expenses incurred are recorded in 2017. And we also want to make sure that all the assets and liabilities at the end of the first year, December 31st, 2017, are correct. That's one key reason for doing adjusting entries, to make sure all those balances are correct and in the right periods. The second thing we remember about adjusting entries is that none of them involve cash. So think about those two concepts as we're going through. Revenues and expenses need to be recorded in the period that they're earned if revenues, incurred if they're expenses, as well as balance sheet accounts being up to date. That's one thing. The other thing is none of them involve cash. So if we have a look at our first item here, it says that the unadjusted balance in the office supplies account was $850 at the end of 2017. The unadjusted balance in supplies expense was zero. So that means they haven't expensed anything yet for supplies. But now, of that $850 that we show sitting in supplies at the year end, we now know that after we've done a physical count, there's only $100 of supplies left. So now, I guess I'm going to have to put that like that so you can see the screen. So anyway, we now know that if there's 100 left in supplies and we've got 850 in the account, we have to make sure that we adjust the office supplies account to bring it from 850 to 100. So what does that mean? That means we're going to have to record an expense. Don't forget, when we use up an asset, we record an expense. So what would that look like? Well, the journal entry would be to debit supplies expense, which increases an expense and reduces shareholders' equity by $750. And we're also going to have to reduce our office supplies account, which is an asset account, by $750. So you'll notice again, if we look at the transaction here, the journal entry, we can see that we're recording the supplies that we've used up in 2014, which was $750. How do we know? Well, we had 850 in supplies, our asset account. At the end of the year, we've only got 100. So that means we have used up $750. So whatever we've used up of the asset is expensed on the income statement. So now we have, once we post the entry, we're going to have a balance in office supplies. It started at $850. We reduced it by $750. We're going to have 100 left, which is what we said we should have, right? And then what we're going to show as a supplies expense, or an expense in the income statement of $750, to show how much of that $850 we've actually used up. You can see here, when we look at assets equals liabilities plus shareholders' equity, you can also see that the balance sheet equation, or the accounting equation, is still in balance. We've got our assets going down by $750, which you can see here. No effect on liabilities because neither the expense nor the office supplies account are liabilities. But you can see your shareholders' equity account is going down by $750 because your expense is going up. When expenses go up, it decreases net income. If income goes down or is less, that means your retained earnings is less, and when retained earnings is less, your shareholders' equity is less. So you can see what happens on the left side of the equal sign is the same as what happens on the right side. So the accounting equation is in balance. Now let's look at the second example. It says here that we have wages that are unearned by earned by employees during 2017 that are not paid, and they're not recorded yet at the end of December 2017, and that's $3,700. The last paychecks were issued on December the 28th, and they're not going to pay them until December or January 6th, 2000, and that should be 17. Okay. Now, so far during 2017, we've expensed and paid in wages $40,000. So we now have to make a journal entry, an adjusting journal entry, to record costs incurred because employees worked for us on the 29th, 30th, and 31st of December, but we haven't yet paid those expenses yet. So we've incurred an expense that we haven't yet paid. So again, that's one of the reasons we make adjustments, to make sure the expense is recorded in the proper period. So what we're going to want to do now is we're going to want to debit or charge up the wages expense, $3,700, and credit wages payable, because that's the value of what we're going to pay them in January, right? So we have to set it up as a liability now because we're going to pay it in January. So at the end of December 2017, right, that's going to represent a liability because we're not going to pay it until January 2000, and that should actually be 18, right? So therefore, we're going to credit wages payable $3,700, and we're going to debit wage expense for $3,700. So now, if we think about it, the balance sheet equation is still in balance, right? Because we didn't have any of these accounts. None of them affected net assets, is no effect. But liabilities went up because we credited the liabilities, and our shareholders' equity came down because we recorded an expense. So when expenses go up, shareholders' equity goes down. So we can see, as a result of making this journal entry, the accounting equation or the balance sheet equation is still in balance. So now, so far you notice that we haven't affected any cash accounts, right? So now let's have a look at the next transaction. It says here that a portion of the store's basement is now being rented for, here it says, for $1,100 a month, and they were renting it to K. Fry. On November the 1st, 2017, the store collected 6 months rent in advance from Fry in the amount of $6,600, and they credited the unearned rent revenue account. Anything that says unearned, if it's an unearned revenue of any kind, unearned sales revenue, unearned rent revenue, unearned service revenue, unearned fees, sometimes we refer to fees, as revenue as well, type of revenue as well. When it has unearned, it means it's a liability, right? So we have an obligation when we collect that money in November. We set it up as an unearned revenue, right? So now, that's $6,600. But because we provided tenancy to K. Fry from November 1st all the way to December 31st, we have to draw down on that liability, right? We don't have anything in rent revenue now at the end of December 2017, but that doesn't matter. The bottom line is we got to put some of that unearned has now been earned. So what are we going to do? Well, we're going to debit the unearned revenue for $2,200 and reduce the liability. How do we know? Well, if we received $6,600 from Fry, our tenant, on November the 1st, and we've provided tenancy for 2 months of those 6 months, because don't forget that $6,600 represents 6 months rent, but we've now earned 2 months of it. So what does that mean? We're going to have to draw down on that liability by $6,600 times 2 over 6, or times 1 over 3 if you want to, reduce the fraction. That's going to give you $2,200. So we've now earned rent revenue of $2,200, and that's $1,100 a month for 2 months, the 2 months being here, November and December, and we're going to draw down on the unearned rent revenue because it's no longer a liability or an obligation for us as ABC Company, because we've provided tenancy. So we're going to draw down on it by $1,100 a month times 2 months, or as we say, $6,600 that was originally set up as an unearned revenue for 6 months, but we've now used up or drawn down on the liability by 2 months because we've provided tenancy. So what would that mean? Well, our assets are not affected because none of these are assets. Liabilities went down $2,200 because we provided 2 months of rent or 2 months of tenancy, right? And our shareholders' equity account's gone up by $2,200 because our revenue went up. We credited rent revenue. So we can see there's no effect on the left-hand side of the equal sign, and the net effect on the right-hand side of the equal sign, it nets out to 0. So no effect on the asset side, net effect on the liability plus shareholders' equity side, 0. So therefore, your balance sheet equation or your accounting equation is still in balance. Now, let's go down to our fourth transaction. And you can see here we're dealing with depreciation. ABC Company purchased delivery equipment at the beginning of the year. That must have been at the beginning of the year, 2017. They're estimating that depreciation is going to be $3,000, but they haven't recorded it yet. Well, the standard entry to record depreciation is what? A debit to depreciation expense and a credit to accumulated depreciation. And that's going to be for $3,000. So what do you notice? Depreciation expense, because we're recording an expense has gone up, which means shareholders' equity goes down. And notice here, we don't credit the equipment. We credit accumulated depreciation on the equipment. Why? Because we want to leave the cost intact. So we don't want to adjust the cost. We bought it at a particular cost, and we need to track that cost. So we record the allocation of that cost to an account called accumulated depreciation. And accumulated depreciation is a contra asset account. Why is it a contra asset? Because its normal balance is credit. So when we're building up the balance of accumulated depreciation, we credit it. When we're building up the balance of the equipment account, we debit it. But this is a contra. Why? Because it's a contra to the equipment account. And when we have contra, we mean the normal balance of the contra account is the opposite of the normal balance of the account equipment to which it's contra. So the normal balance of equipment would be debit. The normal balance of the contra asset account, accumulated depreciation on the equipment, is credit. So therefore, the credit balance in the accumulated account goes up. So it goes up. But at net, what happens? The book value or the carrying value of the asset at net, assets go down. Oop, don't want that. Assets go down, right? So when the contra asset account balance goes up, the net balance for your assets go down. So now, what are we going to do here? Well, so now what we see here is that the balance sheet equation is still in balance. We've got assets going down by $3,000, right? Because your accumulated depreciation account went up, right? That means that the cost less the accumulated depreciation is going to have a net book. That's the net book value, and that's going to be less. Your assets reduced from its cost to its net book value. So assets go down by the amount of accumulated depreciation. None of these are liability accounts. Remember, this accumulated depreciation account, it may look like a liability because its normal balance is a credit, but it's a contra to an asset account. So it's a contra asset account, not a liability. So liabilities are not affected. And your shareholders' equity account, it's going down $3,000 because your expenses are going up. So you can see assets go down by the amount of accumulated depreciation that you've put in there this period. And your shareholders' equity has gone down by the amount of depreciation expense you recorded. So the left side and the right side both go down by the same amount. So your equation is still in balance. Now, let's look at another transaction. This is a prepaid insurance related transaction. This one says here that on December the 31st, 2017, we had a prepaid insurance balance unadjusted $4,800. That amount was paid in the middle of the year, right? for a 2-year policy with coverage beginning on July the 1st, 2017. So what happened is that these guys bought coverage for their company on July 1st, 2017. But the policy was going to be effect for $4,800 for 2 years. So that $4,800 represents 2 years of insurance. The unadjusted balance in the insurance expense account was $800. So they already had $800 there on July 1st, 2017. That's in the expense account. And that was the cost of insurance that they expensed from January to June 2017. So what happened is that we expensed insurance for the first 6 months of 2017. We renewed our coverage in July. Now we've got to expense coverage from July the 1st to December 31st, 2017. So our coverage expired, whatever coverage we had on June the 30th, it expired, and we incurred that cost from January to June. Now we bought our insurance, we renewed our policy, and now it's going for 2 years. So we got a book of that 2 years of the renewal that we started on July the 1st. We got a book 6 months of it, July 1 to December 31, 2017. We got to book it into insurance expense. So we're going to have to calculate. Well, if this $4,800 is for 24 months or 2 years, how much would there be from July the 1st to December 31st? Well, if that's 24 months, then we want to find 6 months of 24 months. So what we can do is we can debit insurance expense for $1,200 and credit prepaid, reduce it by $1,200. Why? Because $4,800 was the renewal that we had for 2 years, but we renewed on July the 1st of this year. We want to know how much of that prepaid insurance of $4,800 did we use up. Well, we've only used up 6 months of it. If that represents 24 months, then 6 months of 24, that 6 months is from July the 1st to December 31st, 2017. So we're going to debit insurance expense for the last 6 months of 2017 from July 1 to December 31, $1,200, and we're going to reduce our prepaid from $4,800. We're going to reduce it by $1,200. So what happens to our accounting equation? Well, our assets came down $1,200. Our liabilities, none of these are liabilities, and our shareholders' equity's gone down because our expenses have gone up. So notice again, adjusting entry, this one is recording all the expenses incurred in the 2017 period. And we also see that none of these adjusting entries, including the one we just did here, none of them are involving cash so far, right? Now, let's look at the next one, which is the last one. And what we see here is we see that ABC Company did some repair work for its tenant, K. Fry. At the end of December 31st, Fry hadn't paid ABC Company for the work they did. It was $750. The amount has not yet been recorded as revenue. Okay, they expect to collect in January 2018. So all we're saying is that we're going to set up an account receivable. Why? Because it's money that we've earned as ABC Company, but we haven't yet collected it. So any amount that we've earned, but we haven't yet collected from the customer, we're going to debit accounts receivable because we are entitled to receive that money at a later date. We expect to get it in January, but we've already earned it. And you'll remember earlier in the course we talked about recognizing revenue, right? So again, we would have recognized revenue at the end of 2017, even though we haven't got the cash yet, because we've earned it, $750. So again, if we look at the accounting equation, what do we see? We see that our assets have gone up by $750 because the receivables gone up. None of these are liability accounts, so they're not affected. But shareholders' equity's gone up because your revenue's gone up. So this is us recording assets, bringing their balance up, and recording revenue that we've earned that we haven't yet collected. So we're booking the revenue in the period in which it's been earned, even though we haven't collected the cash, and we're booking and making sure our asset accounts are up to date, specifically the receivable. Because we've earned the $750, we have every reason to expect it's going to be paid to us, so we set it up as a receivable. Okay? So now, let's get some questions here for you. What would be the ending balance in the prepaid insurance account at the end of the period? Well, you remember what we told you back up here was that we had prepaid balance of $4,800. Don't forget, we reduced our prepaid by $1,200 with this entry. So we would expect to have $3,600 left. If you want to see a T account, we started off with $4,800 in the prepaid. That was the balance, that was the amount that we paid on July the 1st, 2017. This is the amount of the asset, $1,200, that we used up and recorded as expense in 2017. So we have $3,600 left. What would be the ending balance in the unearned revenue account at the end of the period? Well, don't forget we had unearned, I guess I should say rent revenue to be specific, so I'll just put rent in there as I recall. We had unearned rent revenue, if you'll remember back up here, it was $6,600, right? We collected it on November the 1st. But as of December 31st, we reduced the liability because we provided 2 months tenancy. So of the $6,600, which was a payment from Fry for 6 months rent, we earned 2 months of it. So we're going to record revenue for ABC of $2,200, and we reduce the unearned rent revenue, the liability, by $2,200. So now, if we had $6,600 in it and we reduced it by $2,200, that's where we would see here that we have $4,400 left in the account. Now, what would be the balance in the wage expense for the period? Well, if you go back to your question told you that up to December the 28th, they had $40,000 in wage expenses already booked in the account. Those were wages incurred in 2017 and also paid. But we had to book an adjusting entry, you'll remember, for $3,700, which was to expense wages for the last 3 days, 29th, 30th, and 31st of December, for which employees won't be paid until January 2018. And if you remember, we debited wage expense for that, and we credited wages payable. So our wage expense account has now gone up from $40,000 that we had in it, the unadjusted balance. We're going to add the impact of the adjusting entry. So on the adjusted trial balance and in your income statement, you're going to be showing $40,000 plus $3,700, which is going to get you $43,700. And in your insurance expense account, we kind of talked about this when we looked at the prepaid insurance balance, but you'll remember if you go back to the question, they had already expensed from January to June 30th $800 in the insurance expense account. Then they renewed the policy. This $1,200 was the debit to insurance expense that we made to expense insurance from July the 1st to December 31st, 2017. So in total for 2017, we now have $2,000 in it. So you can calculate it, but sometimes it's easier for some students to visualize in the T account. And supplies expense, Don't forget, the question told us that we started with nothing in supplies expense. And during the year, if you go back to our first entry, you'll remember that we debited supplies expense for $750. So we should see in the adjusted trial balance and in the income statement $750 in supplies expense. So this concludes this short video on adjusting entries and also helping you calculate balances for the financial statements that would show up in the adjusted trial balance as well and be transferred to the statements. So I hope you found the video helpful.